Ladies and gentlemen, Tesla stock is down around 0.5% here in after hours, but we have some big things to share with you, including Morgan Stanley's Adam Jonas that has cut his Tesla price target, FedEx being the latest company to sound the alarm on the US economy, while Nike is also out with earnings today and after hours, and they expect that their sales will plunge as they face tariffs and a sliding consumer. Jeffrey Gundlach, he is known as the Bond King, said on CNBC the chance of a recession is higher than 50%. We also have some economic data coming out tomorrow morning that you need to know. So ladies and gentlemen, thank you for joining me. I want your thoughts on all of this down below in the comment section. And do me a quick favor, if you like the value and or perspectives provided in this video, hit that like button and subscribe to the channel. It helps to push these videos out to as many people as possible. And trust me, as a Tesla-centric channel that also covers the broader markets, I think Tesla investors probably need to hear this, for better or for worse. And let me just tell you right now, there is a doom and gloom potential this year, or there is a potential that things are overdone in Tesla and in the broader markets, with sentiment included. And honestly, I can't tell you what is going to happen. The best I can do is give you the different scenarios and how to potentially prepare your money to win no matter what happens. And I think that's honestly the best opinion that you could get right now, because if anyone confidently says we're going into a recession, you probably shouldn't listen to them. Or if anyone confidently says there's no chance of a recession this year, you probably shouldn't listen to them either. In this market, there's so many variables that could change the entire outlook, that do change almost day by day. It's hard to know with any degree of certainty. But first and foremost, let's get into FedEx. Now, we're going to talk Tesla. We're going to look at option activity, what the short sellers ultimately did today, and some other news for Tesla. But FedEx used to be seen as the bellwether of the economy. Like, when FedEx used to have good things or bad things to say about the economy, I'm talking like 2020, 2019, 2018, 2017, 2016. When I first started investing, like, FedEx was the bellwether, okay? What that means is if FedEx said the economy is doing good, then it's probably doing good, right? That's a good hint towards the broader economy. If FedEx warned about a slowdown, then people took that very seriously. That's what a bellwether company means. Today, not as much of a bellwether. I still think so. But FedEx has honestly had bad things to say for a long time about the economy, which makes you wonder, how are we already not in a recession? But nonetheless, this headliner here says FedEx is the latest company to sound the alarm on the US economy. It goes on to say that FedEx cut its profit outlook for a third straight quarter, saying that it reflected, quote, continued weakness and uncertainty in the U.S. industrial economy, hitting demand for its business-to-business services. That weakness continued to pressure FedEx higher margin B2B volumes. The dynamic was most pronounced at FedEx Freight business, where fewer shipments and lower weights continued to hamper results, albeit less than last quarter, the executive said. They say, quote, the current environment, is adding uncertainty to demand. During the quarter, FedEx navigated, quote, a very challenging operating environment, including a compressed peak season and severe weather events. And I mean, this is really not anything new for FedEx. FedEx has been warning about the consumer since 2023. It's just really gotten worse here in the last couple of quarters. Again, the third straight cut in guidance. It's not looking great at this point. And it is, I believe, one of those bellwether companies to the broader economy. Now, Nike expects that sales will plunge in the current quarter as it faces tariffs and sliding consumer confidence. In a conference call with analysts, finance chief Matt Friend said Nike expects its sales volumes in the fiscal fourth quarter, which is set to end in May, to be at, quote, the low end of its mid-teens range. It also anticipates its gross margin will fall between 4 and 5 percentage points as it ramps up efforts to clear out excess inventory and stale styles that are no longer resonating with consumers. Nike warned on Thursday, saying that sales will drop by a double-digit percentage in its current quarter as the sneaker giant's turnaround plan takes longer than expected while it contends with new tariffs and sliding consumer confidence. They go on to say, quote, "We believe that the fourth quarter will reflect the largest impact from our win now actions and that the headwinds to revenue and gross margin will begin to moderate from there. We are also navigating through several external factors," this is the important part, "that create uncertainty in the current operating environment, including geopolitical dynamics, new tariffs, volatile foreign exchange rates, and tax regulations, as well as the impact of this uncertainty and other macro factors on consumer confidence." So again, another company that is by definition discretionary is warning about the consumer. I mean, you can add Target, Walmart, Home Depot, Best Buy, Lowe's, Dollar General. I mean, Dollar General flat out said that no matter what the income demographic is that shops at Dollar General, whether it's higher income, middle income, lower income, they're all starting to trade down. Dollar General said that was really picking up pace in the last couple of weeks alone. This is not to say we're guaranteed going to go into a recession, but you also can't rule that out either. There's honestly more signs towards recession than there is that everything's fine, that markets have overreacted. And that gives me a little bit of pause in this current environment. Because again, as I've said before here on this channel, and I know it's unfortunate if you're a super bull out there, we're really high still. I mean, expectations are still super high. If we were to theoretically go into a recession, like we could easily fall to your lows of 2022, which is about a 40% decline from here. All things considered, if nothing really changes, tariffs go into effect April 2nd, trade war continues, consumer kind of trends at where it is, the upside on this market is not that much, okay? Just to get back to new all-time highs from here, I think would be generous, given the now new information that we have. That's only looking at like an 8% upside. The downside is potentially 5 times larger than the upside. That's what I don't like about this market. Now, that's where it gets interesting for Tesla, because Tesla is already down 50%. Now, in like a bad recession, Tesla could fall to $80 per share. Like, that is certainly possible. It's not impossible. Let's call it that. That would still be a decline of 66% or so, but reasonably, like, could you fall to 120, 140, where you were roughly April of 2024? Sure, that would be a 41% decline from here. And that's why, even though Tesla's down 50%, I don't want to go all in on Tesla. I want to slowly buy, keep a lot of cash on the sidelines so I can go really heavy if shit ultimately hits the fan. Because let's be honest, Jerome Powell said uncertainty more times than, I would like to admit. He essentially said, by saying uncertainty like 30 or 40 times yesterday, that they have no idea what's going to happen. Like, your guess is as good as theirs. And you got that vibe, right? From the press conference, the dot plot kind of suggests that as well. And Powell is back. The Powell put is back. But to what extent would we need to see economic pain for that Powell put to come back? I don't actually think the threshold's super high. Like, give us a bad jobs report, like something that's close to negative. Yeah, you're going to get Powell that's cutting rates. But at that point, is it too late? Probably. I mean, there's only so much Powell can actually control. As you're going to hear in just a moment, Jeffrey Gundlach, known as the Bond King, he says that even if the Fed cuts rates, you may not see an uptick in demand from consumers because people are really just still trying to get used to the price levels being so much higher than they were before. Like, I mean, you go to a restaurant or Chipotle and a burrito is like $20, right? A dinner is like $25. Some areas more than that. People just can't afford that. Even if the Fed cuts rates, it's kind of like The Fed raising rates only hurt the manufacturing sector. I mean, the Fed cutting rates, how much is that actually going to help the demand picture? You could make an argument that it's not nearly as effective as it used to be. So again, the Powell put is essentially back. But if you go into a recession, sure, that helps if the Fed is cutting rates, but the markets are still going to crash. You're still going to hit probably the lows of 2022. Like, that would still happen. I mean, let me just explain this to you. Right now, Wall Street still expects between 11 and 15% EPS growth this year from 2024. Do you know what the average year is from 2000 until 2024, the last 24 years, year over year EPS growth for the S&P 500? 5.25%. So on the low side, you're over double the historical average. And on the high side, you're triple the historical average, or right at about triple. So you're not pricing in a slowing economy this year. You're pricing in a great economy this year. And even the Fed at 1.7% GDP, like the consensus is not recession at this point. People still are optimistic about economic activity. There could be some downside surprises there over the coming months. Now, what if I told you in the history of recessions, if we take out some of the weird like one-offs like '08 for an example, EPS for the S&P dropped over 50% that year because banks had such massive losses. It really just dragged down everything. But if you strip out like '08 because of the weird anomaly there, the average decline of EPS growth, so on a year-over-year basis, is about 15%. Okay, so instead of actually getting 11 to 15% EPS growth, the average recession, you would see negative 15% EPS. If you attach a, roughly 15 times multiple on that, you're looking at 40% downside from current levels. Like the fundamentals match up to 2022 lows. And I don't say that to scare you. I say that to put it into context. What could happen, not what's guaranteed to happen. Do not twist my words here like some people do in the comment section. No, it's what could happen, but not guaranteed to happen. There is the other side of this that Trump could come out in 2 minutes from now and say, we now have a fair trade agreement with all. Okay, I don't think that's going to happen. The probability of that is probably low, but it's a possibility. In that scenario, business investment would likely pick up and the odds of a recession would fall. But unfortunately, what I think is really hitting consumer confidence right now that's really affecting how people are spending money is Doge. Even though you've only cut like $100 billion, the debt clock currently says like 200 billion. I'll show you that now. But in all reality, there's only been like $100 billion cut so far from the deficit, if you will, okay, or the budget. So there's varying numbers you can go off of here. Even if this is true, 223 billion, doesn't matter. It's a drop in the bucket compared to what they need to cut. So odds are cuts from Doge are going to pick up. Whether or not they do, it doesn't matter. Donald Trump just signed an executive order to get rid of the Department of Education. For better or for worse. This is not politics. Those people are going to be out of a job. Those restaurants that those people frequented, they're going to be in a worse position. Okay, maybe it's the daycare that those individuals had to pay for that's also going to be hit from that. Or what about just the in total 3 million government employees that now do not know if they're going to have a job next week? I don't know about you guys, but if I knew that maybe next week I would have no income, I probably would not be spending. Okay, that's quite logical, right? But what a lot of people also fail to kind of remember, as the government has been essentially giving out this free money, there is millions and millions and millions of workers, anywhere from 5 to 13 million employees at companies where those companies take in 70% of their revenue from the government. So you have a lot of companies out there that employ people that may or may not get their contracts renewed. It's that uncertainty that is putting a damper on consumer spending. When you think about it like that, let's call it 13 million people are now uncertain whether or not they're going to have a job. Well, on paper, there's 168 million working people in America. You know, that is an issue. And I'll give you an actual percentage here. Essentially, almost 8% of the workforce is now uncertain if they're going to be laid off next week or tomorrow, right? Any given moment. That is what I think is hurting the economy, whether Doge does much or not. That's where the issue is coming from. Now, to make matters worse, you have tariff uncertainty, so even companies that have no affiliation with the government are like, do we really want to go out and invest here or there or make a big business decision and hire new people if we don't even know what's going to happen? Probably not. And once things start to slow down, not too long after you start getting layoffs or really layoffs through attrition, like if you always got 40 hours from your job, maybe now you're only getting 35 hours or 32 hours, right? Because maybe there's not as much to do, right? And then eventually those people leave their jobs and, well, that's layoffs through attrition. And then you don't hire somebody to fill their spot. Next thing you know, that's happening on a mass scale. It's not pretty, okay? That's what it looks like to me. But as I said in the previous video, that does not mean the markets will not rally, right? We are so news headline driven that markets could move higher from here. It's like 2022. You did not fall in a straight line. That's ignorant to even say that, right? It's ignorant to say that markets can't bounce from here. They absolutely can, right? And they probably will. 200-day moving average is a pretty critical level for the S&P. I think that's fair. But this was one of the fastest sell-offs we've ever seen in market history. You have to bounce. But what you do on that bounce is reset your momentum indicators. Like your RSI is back to 41, almost 42. You're only 2.5% off of your lows. So now if tomorrow we fall 2.5%, theoretically, get back to a new low or fall, let's call it 3%, the RSI is not going to be at 27 like it was before. It's going to be at like 35. So then you have more room to sell off before you get too oversold again and then need a bounce. Okay. Yeah, that's kind of the setup that I see. Same is true with the VIX as well. Like the VIX was at 28, 29, almost 30 at one point. Now it's down to 19.80. Fear has subsided, but you're still near the lows. So if you fall 3%, the VIX is probably not going to spike all the way up to 29 again, right? So you've reset your, to some extent, you could reset a little bit further. RSI could go back into the 50s, right? The VIX could fall back to like 17, 16. But for the most part, you've already reset your velocity indicators. And that sets you up for that downside again. That is what I would be on the lookout for coming soon, especially if we can't break above that 200-day moving average. But again, it's really going to come down to the news headlines that come out. Also in the news today for Tesla, Morgan Stanley's Adam Jonas cut his Tesla price target to $410 from $430 due to lower estimated vehicle deliveries of 1.61 million for 2025 from 1.92 million. He keeps an overweight rating. So, I mean, that is kind of a wild estimate because last year you delivered around 1.8 million deliveries. He was expecting delivery growth of about 120,000 units. Now he's expecting a decline of almost 200,000 units from 2024. That is a huge difference. I'm surprised the price target reduction was only $20, but it makes sense with what he says next. He says, quote, "It is not particularly narrative changing for our investment thesis. He remains bullish on Tesla's AI initiatives and humanoid robot opportunity." That's really what it is. FSD, robotics, right? That is the thesis for Tesla. So deliveries don't matter as much, and that's why he didn't reduce his price target even more. But still, that kind of explains why Tesla has fallen 50%. I think it's recession fears. I think it's, investor sentiment. Some investors can't tell their left hand from the right, right? Those guys, they've sold Tesla, okay, a long time ago. So I think you have a lot of that going on. But also internally, I think a lot of people have reduced their estimates for Tesla deliveries this year. And I think that could be an upside surprise, even on a week-by-week basis. Last week in China, Tesla blew away all other EV models and deliveries. That is probably going to continue. And it's probably going to become pretty evident in Europe as well that the Model Y is here. I mean, they're being delivered. And we're probably going to get really good numbers that could be an upside surprise and actually push Tesla higher. 280 is the big level I want to see. But your 20-day moving average currently at 266 with a lot of resistance here in the short term at 250. If you break above 250, you're probably going to slingshot upwards to that 260, 270, maybe even that 280 level. But again, I'm buying a little bit at a time because I want to keep cash on the sidelines in case, as Jeffrey Gundlach says, there's a 50, 60% chance of a recession this year. That is way too high. And I agree with those numbers. Way too high to not have cash ready to go. So I think it's a mix of holding your long-term stocks. I haven't sold anything. Be ready if markets recover. You don't want to miss the recovery. Come on now. Let's act like we know what we're doing here, right? You don't want to miss the recovery because you never know what's going to happen, but you don't want to be so vulnerable where you have no cash to buy. The markets are not crashing right now. Sure, yeah, they're down like 8% from all-time highs, 7% or so. But if you fall 40%, you want to have a lot of cash ready to go because odds are we're not going to stay down 40% for that long. Now, with that said, take a listen to Jeffrey Gundlach, known as the Bond King, that says the chance of recession is higher than 50%.
Degree of uncertainty that it's hard to have definitive moves in the market because you just don't know what tariff policy is going to be. You don't know to what degree the economy is going to continue to weaken as well. And I want to ask you about that. On the chance of a recession, the chair said, well, there's always a 1 in 4 chance. Quote, it's moved up, but it's not high. You've had the Treasury Secretary on this very network talk about a detox that is needed. You have had an administration that really has not gone out of its way to talk people off of the idea of a recession. I think in some cases you can make the argument that they have almost telegraphed that you could have one. And if you do, we'll be better in the long run anyway. Your thoughts on all that?
Well, the change in government spending, I hope, is going to be to less government spending. Certainly, that which is the purported idea of this DOGE situation. And lower government spending is going to lower the pace of economic growth. I mean, we've been living on, $2.2 trillion is the actual budget deficit for the last 12 months, $2.2 trillion. And if you're going to get that down to any sort of sensible number, it's going to knock a lot out of GDP. The one thing I think that is really bizarre is people that say that we're going to get growth up to like 3% real or something like this, or even 4%, 5% nominal, and at the same time we're going to balance the budget deficit. Balancing the budget deficit is not going to help increase growth. That's what the detox is all about. You've got a problem. You know you have a problem. You've got to start solving the problem. And I've been in favor of this for a long time. I think cutting 100, it's kind of disheartening that cutting $100 lousy billion potentially out of the government budget is being met with hysteria, as if that's even a drop in the bucket. I mean, it's nothing. So we need to cut a lot more than that if we're going to get to a true detox. So I don't know if that can happen because I think the cutting will weaken economic growth, which may lead to a counter response. It's one of the problems when you get yourself in one of these vicious circles that we've got ourselves in. But I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters.
Wow, higher than 50% for a recession.
Yeah, I think 50 to 60 is where I am. Yeah, and I don't think you're going to get a rally out of the long in the Treasury bond market. I think that already happened. we had that Pavlovian response, and we had the 10-year down to 360, and now we're back up at about 4.25, and I'm not sure we're going to go below 4 again, in spite of the fact the economy may weaken.
How much of a risk is stagflation? I read, one person's comment today within one news article saying that we already have a, quote, whiff of it, but it's with a small s, not a large S. Is it a real risk?
I think it is. It's certainly non-zero. I mean, the tariffs could very well be inflationary, and the inflation rate is going higher anyway because of the base effects of what's rolling off from last year. And so I think they just downgraded GDP, so we're getting closer to recession, and they just upgraded the inflation forecast, although just for this year. I do think it's kind of wishful thinking to think that somehow magically it's going to go back down to 2% in 2027. But I think that forecast is mostly hope that that's going to happen. We don't see. I mean, with the Fed saying they're going to cut interest rates and tariffs coming on, I have a hard time seeing how the inflation rate is going to settle in at 2%.
Now, we in fact do not have much for economic data tomorrow. We do have retail sales coming out for Canada, which is highlighted in black here. That's like a medium volatility catalyst. Wall Street's probably not going to pay attention to this. I think you probably should, because the United States and Canadian economies kind of go hand in hand, as you can see from this chart of unemployment. Blue is the United States. The green dots here are Canada. We kind of go hand in hand. Okay, so if Canada materially weakens, partly because of tariffs, partly because that was already the trajectory that they were on, I think it's kind of ignorant to say the U.S. economy is not going to weaken further. So I do want to watch those numbers. Good news, I think, is good news, and bad news, well, will be bad news. Now, we do have a speech from Fed Williams tomorrow at 8 o'clock in the morning. We want to start paying attention to, do Fed officials start to sound the alarm? Do Fed officials start to sound concerned? Now, on the summary of economic projections, what a lot of people missed was some of the negative projections, right, from some Fed members. There's specifically one Fed member that's pretty bearish. There's one dot plot that thinks that the unemployment rate could be between 4.6 and 4.7% by the end of this year. That one's not too crazy. But if you look at GDP, there's one member that thinks GDP will be between 1% and 1.1%. Another member that believes GDP will be between 1.2 and 1.3%. And then even, 3 members that think GDP is going to be 1.4 to 1.5%. Like, there is some members on the FOMC committee that are nervous. And then even 2026, 2027 GDP, there's one member down here that's 0.6 to 0.7% for 2026, 2027, right? That's, somebody's a bear out there. Somebody does not feel good about the economy. And if we start to see that expressed by more Fed officials, it'll give us a heads up on maybe what the broader kind of trend is for the Fed. Powell made it clear he's not super concerned about inflation. He's more concerned about supporting the economy. So we will see if that kind of gets echoed by other Fed officials. Ladies and gentlemen, that is going to do it for this video. Keep in mind, tomorrow is a pretty big option expiration as well. So there could be some incredible bouts of intraday volatility. Have a fantastic rest of your night, and I will see you in the next one.